market. For more on what this means for the U.S. banking sector, though, we are joined by Devin Ryan. He's the Director of Financial Technology Research for JMP Securities. Good morning to you. You probably heard the last conversation we've been having, both about the Fed, but also about why some of the regional banks in the U.S. that we've had question marks over haven't had these type of arranged marriages, a la what we saw over the weekend in Switzerland.
Hey, good morning, Andrew. So I think, the challenge right now is that I think the U.S. banking system, from a capital position and just from a strength position, is in a good spot. The challenge is that, confidence and stability aren't there at the moment. And so if you look at what happened at Silicon Valley, they were on a pretty extreme end of the spectrum in terms of, asset liability duration mismatch and some of their other issues. And so, that is a standout. And so I think a lot of the other banks are looking, at their position saying, we don't look like that. And yet, there's still this little bit of crisis of confidence going on right now. So I think that's the push and pull right now. And it's really tough for, I think, equity investors to underwrite all those moving parts.
Devin, what is your sense of deposit flight? It's all anecdotal from my perspective. I'm calling around, obviously, and hearing from some of the big banks that the phones are not ringing off the hooks the way they used to, or at least a week ago. That would seemingly be good news. That news, though, if that is true, is not reflective of the stock prices of these banks.
Yeah, so that's my impression as well. That I think the first couple of days there, no one knew what was going on. So money was moving. I think money, in some cases, actually, we even heard that last night. Some money has moved back to certain banks. But I think it's not one size fits all. I do think that money did move around in those first few days, and so that affects earnings power too for companies as you lose depositors, and so therefore your assets become less productive as well, or on a net basis. And so I think that we have seen a little bit more stability in kind of the broader banks, but it's still relatively fragile, and I think that's the question mark here, just in the broader market. But that is what we've heard as well.
Devin, given that banking is oftentimes called a confidence game, how do you think about the regionals? And I'm putting, we can put First Republic up on the screen. We could put, PacWest up on the screen. You could go through the list. Is there any bank on that list right now you feel super comfortable saying, you know what, this is something that you think shareholders should be buying? Are there banks on this list that you think they should be selling? What would you be doing?
Yeah. So, Andrew, I've done this long enough, through the financial crisis. Things don't go back to normal in a couple of days. This is going to take time to wash out, and there's a lot of second derivative, third derivative effects here. And so earnings power is being affected. We just talked about interest rate expectations coming down a lot. Most banks are actually asset sensitive. So lower rates does hurt. And now we're talking about the economy potentially tightening as well. And so now you have to start to think about credit exposures. And, to me, if that's the conversation, that's a good thing. That becomes a stock picker's market. The KBW Bank Index is trading at 6.5 times forward earnings. That's 40% of the S&P versus an average of 80%. So, the point is, I do think there are going to be opportunities here. You need to be in the safest, soundest firms where they have good balance sheet, asset liability management. I mean, that's really, and a strong capital base. Devin, so I think, investors should be careful here, but there are opportunities.